Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull bear point and figure market breadth summary chart for July 15th, 2018. Market breadth. With this past week's market advance, our bull bear point and figure ratio at 1.06 rose from 0.92 last week, advancing back into bullish territory. The total count of securities in bullish or bearish patterns increased fractionally to 2,921. The count of bearish stocks decreased 7%, while the count of stocks in bullish patterns increased 8%. The Pirls PNF Market Breadth Summary Chart shows us a market now 1 week in bullish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive our weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 40 points for the second advance in 5 weeks. At a positive 332.12 points, it continues below the January 2018, the February 2017, December 2016, July 2016, and the May 2016 tops. It continues above the March 2018 and July 2017 tops above plus 100 in the last 30 months, and it continues above all 4 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 1 distribution day. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Momentum. The CCI 20 at a positive 111.78 is up from a positive 16.58 last week. At Friday 7/13 close, the CCI 20 daily had 6 consecutive days above zero for a change of trend to Woody's up. The CCI 20 daily is now outside the plus or minus 50 range for a valid zero-line reject long entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 115 weeks ago, while the daily CCI 20 began a Woody's uptrend this past week. The CCI 20 weekly rose to a positive 130.80 from a positive 88.92 last week, continuing outside the plus or minus 50 range required for a valid zero-line reject long entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and only one of the bottom 5 is negative. Summary: S&P Retail and some tech on top. KBW Bank, oil, oil services, gold and silver, and some tech on the bottom. Bullish, computer hardware, comp tech, and S&P Retail have entered the top 5. Gold and silver has left the top 5 and entered the bottom 5. Oil and oil services have entered the bottom 5. Semis and brokers have left the bottom 5. Bearish, disk drives, and KBW Bank continue in the bottom 5. REITs has left the top 5. Networkers has left the top 5. Focus this week from www.realinvestmentadvice.com. Bulls Maginot Line 7-13-18 by Lance Roberts. The following are some key points and charts from this comprehensive technical investment article, which we recommend reading in full. The Maginot Line, named after the French Minister of War André Maginot, was a line of concrete fortifications, obstacles, and weapon installations built by France in the 1930s to deter invasion by Germany and force them to move around the fortifications. The Maginot Line was impervious to most forms of attack, including aerial bombings and tank fire, and had underground railways as backup. For the market, the bulls are currently testing the respective Maginot Line going back to February of this year. While the longer-term sell signal remains intact currently, the market has now risen enough to test the last line of resistance standing between the bulls and a charge to this year's highs. With the Nasdaq hitting all-time highs on Thursday, it is now quite likely traders will try to also push the S&P 500 to new highs as well. However, as of now, the market stands at a critical juncture. As we laid out a couple of weeks ago, it continues to be a battle of wills between the bulls and bears. A break above current resistance will bring pathway number 1 into focus, as a push to previous highs becomes a very high probability event. If, however, the market fails to move higher, then pathway 2 will suggest a retest of recent support at the 50 DMA, which has now also turned positive. The cluster of support which has gathered around the 100 DMA reduces, but doesn't eliminate, the probabilities of a larger drawdown in the short term. As I stated previously, these pathways are not predictions. The analysis is used to make some assumptions about where the markets will likely head, given the various risks we are currently weighing in our portfolio allocation models. Those risks include trade risk, yield curve, tweets from the White House, interest rates, monetary policy, earnings, geopolitical, corporate guidance. You get the idea. Of course, it is hard to believe that just a few weeks ago we were sitting basically where we are today. With the markets rallying, bullish optimism rising, and the market close to registering a buy signal, this time looks a whole lot like last time. However, the question is now whether the bulls can succeed where they failed previously. Momentum is the last stage of the investment cycle. While our short and intermediate term views are more bullishly biased, we are most definitely long-term bears. Ryan's data points above further support that view. The laws of physics apply to the markets just like everything else in life. Trying to deny those laws is akin to saying gravity doesn't exist. In other words, when markets begin strongly trending in one direction, that direction will continue until an unbalanced force stops it. Momentum strategies, which are trend-following strategies by nature, have been proven to work well across extreme market environments, multiple asset classes, and over historical time frames. Thank you for watching this week's Santu Pirls Stock Market Commentary video featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you have been enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.